Hey, my name is Jason Nicholson and welcome to my YouTube channel. In this video, I want to talk about what are the expectations for interest rates to drop even more in 2025. Are they going to drop or are they going to stay where they are for now, or could they increase? I've got some data on that which you're going to want to know about. And this will help you make a decision. Maybe you're purchasing a property, maybe you're refinancing a property, maybe you've got a buy-to-let property. Either way, it's very important that you keep an eye on what is going on. The markets are changing at a dramatic rate at the moment, and so it's really changing on a daily basis, and there's been some big shifts in the last week or so. Now, if you're new around here and you haven't done already, we have new property content as much as twice a day at the moment. We talk interest rates, we talk house prices, we talk property investing, and much, much more. And how you keep up to date on that is by smashing subscribe and hitting the bell notification. Join us and thousands of other subscribers who subscribed this month alone. And let's get some more views on this video. How do we do that? Simple. Smash like, tickle like, do something to that like button. That really helps me with the YouTube algorithm. And I really appreciate everybody that takes a moment to do that. So thank you to everyone. So, interest rates. What a topic. It's been all over the place recently. So last year, 2024, the market was slow. And what I mean by that is not many houses were being sold. There wasn't a lot of transactions. It really slowed down and ground to a halt. So even before the Bank of England started cutting rates, what happened was lenders started cutting rates. I think August was when the Bank of England first did their cut. I recall I was in France at the time. And that rate cut did start to move the market. But it was about a month prior than that we started to see lenders fighting amongst themselves in order to lower rates to get your business, because they don't make money unless they lend money to people like you and I. And so it really did get the market moving again. And so the market at the end of last year started to get busy. Now, this year, the market was very busy at the beginning of the year for a different reason. And that was because stamp duty was going to be going up and everyone was rushing in to get their deals complete prior to that big increase in stamp duty. And so that got the market moving. So lenders didn't need to be so competitive. Then inflation started coming down, which was a key thing. And so inflation is a big indicator on where interest rates might go. Now, we had some inflation data this week and it was bad. We were expecting 3.3% inflation and we had 3.5% inflation. It jumped in just a month from 2.6. Most of that was very frustrating. It was down to energy costs. It was down to water rates. It was down to airfares, stuff that you and I can't control. And that meant that inflation's now high again. So the Bank of England now is looking at pausing interest rate cuts for a while. They want to see what happens. Another thing that you've got to consider is Trump. Donald Trump, you might think we don't even live in America, but if you live in the UK and you want your mortgage rate to go down, you've got to pay attention to what's happening in this trade war. It's not good. It's not good. And whether you like Trump or not is irrelevant. What I'm sure you understand is that uncertainty is not good for businesses. You can't buy what you need. That's going to lead to supply shortages. Prices are likely going to go up, at least in America for sure, but it could hit the global economy. And so we're kind of out the woods a little bit in the UK because we have some sort of trade deal. But what if Europe gets hit? They're talking about putting 50% tariffs on Europe at the moment. If that happens, then you potentially got a real problem, and that could cause our businesses in the UK that deal with EU clients to have problems as well. So the Trump tariffs could be inflationary. That in turn could cause UK rates to go down at a slower rate. And the tie there is that the Federal Reserve, they will pause interest rate cuts. At the moment, they're not looking like they're going to cut for a long time in America. And we like to keep our interest rate at the Bank of England fairly close to what they have. So that's something that we've got to consider as well. Next is the market. Like, how busy is the market? And the market's slow, really slow. In fact, we had 500,000 transactions in the first quarter. For the next 9 months, we're only expecting another 500,000 properties to be sold. That is a low number. And that means that solicitors are quiet, mortgage brokers are quiet, lenders are quiet, everyone, surveyors and everyone is quiet in the UK. So that's a positive. That means that potentially you could get a deal on a property. You can hunt for deals and get better options out there. It also means that you could start seeing some rate cuts by lenders to fight each other and get the rates down. So that's something that would tick a box for rates going down. The first two, inflation and the trade war, aren't great for your mortgage rate coming down. A slowdown in the market is positive if you want rates to come down. And the most important thing is something called the Sonia swap. What does that mean? Well, banks that you borrow from, so you might borrow from someone like HSBC, like Nationwide, like NatWest, those types of lenders. That's where we all borrow our money from. But they borrow from bigger banks. And the rate that they borrow at is set on something called the Sonia swap rate. Now, that is based around where the expectations are, where the Bank of England is going to go with rates. And the expectation right now has changed drastically in the last week. And it's changed because of the inflation data and the trade war problem. And so that isn't good. And so what the expectation was, the Sonia swaps that I'm looking at here, let's give you some examples on how much these have changed. When you saw rates going down, I was making tons and tons of videos for 2 or 3 weeks about rate cuts every day. That was the last update for the Sonia swap was the 22nd of April, and we've got one now on the 22nd of May. Let's see how these have changed. So the ones that really matter to us, 2-year. And so in April and May. Okay, so for the 2-year in April, the Sonia swap was 3.592%. And in May, it has now jumped to 4.628%. That is over 1% jump. That means lenders now have got more expensive costs associated with getting money. Let's look at the 5-year deal. So on the 5-year Sonia swap, it was at 3.881%. And now that has gone up, not as bad, nowhere near as bad, 4.05%. So not such a big jump there. So that means what's likely to happen is 2-year deals are going to get more expensive short term. 5-year deals are going to get more expensive, but not at such an alarming rate. So what should you do? Well, look, if you're looking to refinance in the next 6 months, here's what I would do. I would call a broker now, right now, or at least in the next week. I'd fix a rate. So if I know I've got a deal coming up in 6 months, I'll be calling the broker now, finding the best deals that are in the market, and I'd fix the rate with a lender. Now that rate won't start for 6 months until we get that deal, the deal I'm on finishes and the new one starts. You can get deals as early as 6 months early. Now that locks in your worst case scenario. So that's good. The worst case scenario. So now if rates do go up, which is looking like they might for the next few weeks, then you've got your worst case scenario. But what if rates drop? What if we head into a recession, all the trade war gets sorted, inflation disappears, then rates could go down drastically and very, very fast. In that scenario, because you haven't started this new rate, you can move on to one of the other rates with that lender. So you've got your worst case scenario in that situation. And that is what thousands of people that have watched this channel have done. And so that's what I've seen in comments from all of you guys. And that's what I would be looking at. It was all looking good 2 weeks ago. And now with the inflation coming back, the trade war still looming, it's not. It's a bit more uncertain, unfortunately. And the Sonia swap rate going up means that interest rates could be about to get a little bit more expensive. Let me know your thoughts in the comments. Do smash like, do subscribe, And make sure you check out all the other content as well on the channel, including this video right here.